Hey, hello friends. Welcome back to this 30 CAGR YouTube channel. My name is Raj. And in this video, we are going to discuss about a stock market concept, which is related to the number of trades. But this is actually not a new topic. This is related to one of the topics that we have discussed in our previous videos. Okay. In one of my previous videos, I talked about number of trades, and some of our regular users asked me a very good question, and I thought I will make one extended video so that all the questions will be clarified. Okay. So first we will see what is the video, and then we will discuss about the question and then the solution. Before that, if you haven't subscribed to the channel, please do subscribe and hit on bell icon so that you get to see a lot of new strategies, indicators and algo tools in future. And at times we also release so many festive offers, so you will get access to all the algo tools during those festive offers. So don't forget to hit on subscribe button and click on bell icon. Okay. Now let's go and first see what's the video is all about that I have released in the last few days. So this is the video, one trick that increases your profits permanently, right? What we have discussed in that video is, I will just give you a gist and then we will move to the question. What we have discussed in that video is number of trades plays a key role when you are trading in stock market. Okay, because every trade you take, you have a couple of expenses. One is called slippage and the second one is called charges, right? Charges can be anything, government charges or stamp duties or exchange charges, brokerage, whatever it is, you have to pay the charges, and you also have massive slippages overall. So every trade you take, that's a burden on your capital, right? So you shouldn't be taking too many trades per day, like 7 trades, 10 trades, because let's say we have 250 days trading days per year. If you start taking like 7 trades or 10 trades, it will be 2,500 trades per year, right? It eats away like 40-50% of your profits. So what I told in the previous video is try to take not too many trades. Try to take like maybe 2 trades per day, which is like 500 per year. Or if you really are a full-time trader, you know your strategy well, you have risk management concepts in place, then even if you take 3 trades also, that's fine. Okay, 3 or 3.5 trades on an average is also fine as per statistics. Okay. So now the question here is, some of the users came back and asked me, so you said that it's good if the number of trades are lesser. So how about taking only 100 trades per year? Which means for 2 days you will be taking probably one trade, right? 2.5 days you will be taking one trade. Now we will see, that's a very good question in fact, but we will see whether this is good or bad and what is the solution for that. Now before we discuss, guys, you need to know something called drawdown, because this has a very good relationship with the number of trades. That's the point. See, whenever you are picking up a strategy, you need to think from various angles and various relationships. Okay, this is not told by anyone, you need to experience it, you have to get it with your experience, right? We need to first see what's the drawdown and what's the relationship. Drawdown is very simple. It's like, if you are a beginner, just think of it as a maximum loss, but from the peak. Okay, let's say you have 1 lakh capital and it went to like 1.5 lakh and then it came down to 75,000. Okay, now the fall from the peak here is 75k, right? So this is called the drawdown. Okay, don't calculate from your original capital, but calculate it from the peak. Very simple. But this is also kind of max loss. This is called the drawdown. Now we have a very solid relationship between number of trades and drawdown. Okay, so we will see what that relationship is. Now before that, I would like to give you an example. Let's say there is a strategy A, and the equity curve of that is like this, right? From 1 lakh you reached 2 lakhs as per the backtest report, and this is the equity curve, right? Let's say this is Jan, Feb, March, and like that you got the report until December for one full year. And let's say there is strategy B also, and in this also it went from 1 lakh to 2 lakhs, but it is not as smooth as strategy A. The equity curve goes like this. Okay, now Uh, these are called highs and lows, and you need to pay attention towards this, because if it is a high, your capital is high, which is very good. It's like all time high. But whenever it reaches all time low, your psychology is going to take a big hit, and you are going to probably stop that strategy and hop on to another strategy. Of course, after that, again, it will give you the profit, loss, and then it will finally give you 2 lakh profit. Okay, but you will not be able to trade once you reach these levels, or it will be very difficult for you to trade, right? So, why is this happening? We will see why this happens. Let us say in strategy A, we have like 500 trades per year. Okay. Now, the profit and loss in each trade, let's say, is 1%. 1% profit and 1% loss, right? And in strategy B, there are only 100 trades. Now, with 100 trades, if you have to reach to the same destination, okay, 2 lakhs destination, obviously you cannot have these kinds of 1% profit, 1% loss, right? It's very less. You will not reach your destination. Since your trades are lesser, you need to have higher profit and higher loss, which becomes 5% profit and 5% loss. Okay, it's just an example. So now 500 into 1% profit loss, and here in the second case 100 trades only, but the profit and loss will be higher, right? And now assume a situation where you have maybe 4 consecutive losses, right, in strategy B. Now 4 into 5% loss becomes 20% loss, which is your drawdown. Okay, so this exactly is that 20% drawdown. Okay, whereas in A, let's say again you have 4 consecutive losses, but here since you have just 1% loss, it is only 4% drawdown, and hence your equity curve is like pretty smooth, right? So the point I'm trying to make here is, it is very, very important to ensure that our drawdowns are minimum. And how will our drawdowns be minimum? Our drawdowns will be minimum if we trade in good number of calls, and in each call you should have less profit and less loss. Okay, when I say less, it shouldn't be again too less. Okay, it should be like moderate profit and moderate loss, but a good number of calls, good number of trades you should enter into, right? So I mean, finally, what we learned from this is, it shouldn't be too less, because if you have very less number of trades like 100 per year, then what happens is your drawdown will go higher, which is very bad. At the same time, if you have too many trades like 2500, 2000, 1500 trades per year, then what happens is your expense will go higher. So you need to maintain a fine balance between the maximum number of trades and minimum number of trades. You need to have like good balance. And as I said, 2 or even 3.5 is also fine if you know what you are doing, and if you have your risk management concepts in place, right? I hope this video answers all the questions about the number of trades. And in case if anybody still has any question, you can reach out to our WhatsApp number, or you can also put it in the comments, and I will try my best to answer all your questions. Okay. And guys, if you like this video, please do share this video with other core traders or your friends. And if you haven't subscribed, please do subscribe and hit on bell icon, so that you will see these sorts of concepts more in future. Okay. Thank you so much for watching the video. Have a good day, and see you in the next video.